What happens when silver finally breaks above the 60 mark? Most investors assume that's the finish line, but history suggests it could be the beginning of an even bigger story. Markets don't move in straight lines, and every major breakout is followed by moments that separate emotional traders from disciplined investors. The headlines may celebrate new highs, but what happened next caught many people completely off guard. In today's discussion, we'll break down why silver surged above 60, what unfolded immediately afterward, and what these events could mean for anyone holding or considering buying physical silver. Stay with me, because understanding what happens after a breakout can be even more important than predicting the breakout itself. When silver finally surged above the $60 mark, the financial world reacted as if something extraordinary had happened overnight. News headlines exploded across television, financial websites, and social media platforms. Investors who had ignored silver for years suddenly wanted to know everything about it. People who had dismissed precious metals as outdated investments began searching for explanations, wondering why a metal they rarely thought about had become the center of attention. Yet those who had followed the silver market closely understood that this was not a random event. It was the result of years of economic pressure, shifting global demand, tightening supply, changing investor psychology, and a financial system that had gradually been moving toward exactly this type of outcome. Every major bull market has a moment when the wider public finally notices what informed investors have been watching for years. That moment often arrives suddenly, creating the illusion that prices have exploded without warning. In reality, the warning signs had been building quietly beneath the surface. Silver's move above $60 represented the release of years of accumulated pressure, similar to a compressed spring finally being allowed to expand. The move itself appeared dramatic, but the forces behind it had been growing for much longer. One of the first catalysts was persistent inflation that refused to disappear despite repeated promises from policymakers that it would be temporary. Around the world, consumers experienced rising prices in everyday necessities. Food became more expensive, energy costs climbed, housing remained difficult for many families, insurance premiums increased, transportation expenses continued rising. The purchasing power of paper currencies slowly weakened, encouraging investors to search for assets capable of preserving wealth over long periods. Historically, precious metals have served as monetary assets whenever confidence in fiat currencies begins to decline. Gold often receives most of the attention because of its long-standing role as a reserve asset, but silver possesses characteristics that make it uniquely attractive during certain stages of economic uncertainty. Unlike gold, silver functions not only as a store of value, but also as an essential industrial metal used in countless modern technologies. This dual role creates an interesting dynamic. During periods of economic expansion, industrial demand supports silver prices. During periods of financial uncertainty, investment demand often increases. When both forces strengthen simultaneously, silver can experience exceptionally powerful price movements. Industrial demand had been increasing steadily due to rapid technological development. The expansion of renewable energy projects required enormous quantities of silver because of its unmatched electrical conductivity. Solar panels consume significant amounts of silver in their manufacturing process. As governments committed to cleaner energy initiatives, demand from solar manufacturers expanded dramatically. Electric vehicles added another layer of demand. Modern electric vehicles contain considerably more silver than traditional gasoline-powered cars. Every charging station, battery management system, electrical connection, and onboard electronic component relies on conductive materials where silver often plays a critical role. As global automakers accelerated production targets, silver demand quietly continued climbing year after year. The digital economy also contributed to stronger consumption. Smartphones, medical devices, artificial intelligence hardware, communication infrastructure, semiconductors, and advanced computing systems all require silver in varying amounts. While each individual device may contain only a small quantity, billions of units produced worldwide translate into enormous cumulative demand. Medical technology represented another important factor. Silver possesses natural antimicrobial properties that make it valuable in healthcare settings. Hospitals, wound dressings, specialized coatings, medical instruments, and water purification systems increasingly utilize silver because of its ability to inhibit bacterial growth. Although this sector consumes less silver than electronics or solar energy, it contributes to the broader picture of growing industrial necessity. At the same time demand was increasing, supply struggled to keep pace. Unlike many commodities, silver production cannot simply be increased overnight. Opening a new mine requires years of exploration, permitting, financing, environmental studies, infrastructure development, and construction. Even expanding existing mines present significant logistical challenges. Many silver mines had experienced declining ore grades over previous decades. This meant mining companies needed to process increasingly larger amounts of rock to extract the same quantity of silver. Production costs naturally increased while operational efficiency became more difficult to maintain. Another important reality often overlooked by casual investors is that much of the world's silver is produced as a byproduct of mining other metals such as copper, lead, and zinc. This means silver production frequently depends not on silver prices themselves, but on the economics of entirely different mining operations. Even if silver prices rise sharply, production cannot always respond quickly because mining companies primarily focused on copper or zinc make decisions based on those markets rather than silver alone. Environmental regulations also influence supply growth. Governments around the world introduce stricter standards for mining operations, extending permitting timelines and increasing compliance costs. While environmental protection remains important, these regulations often reduce the speed at which new mining capacity could enter production. Geopolitical uncertainty further complicated supply chains. Several major silver producing regions experience political stability, labor disputes, transportation disruptions, or regulatory uncertainty. Each individual disruption may have appeared temporary, but collectively they contributed to tighter global supplies. Meanwhile, central banks around the world continued navigating complex monetary policies. Years of historically low interest rates had encouraged borrowing, speculation, and asset inflation across numerous markets. When inflation accelerated, policymakers attempted to raise interest rates to restore price stability. However, increasing rates also created new challenges for governments carrying enormous debt burdens. Investors began recognizing that central banks faced increasingly difficult choices. Keeping interest rates too low risked allowing inflation to continue. Raising rates aggressively threatened economic growth, financial markets, and government borrowing costs. This delicate balancing act contributed to growing uncertainty regarding the long-term purchasing power of major currencies. As confidence weakened, more investors allocated portions of their portfolios toward tangible assets. Precious metals historically attract attention during periods when traditional financial assets appear increasingly vulnerable. Silver benefited not only from monetary concerns, but also from its industrial importance, making it attractive across multiple investment strategies. Exchange-traded funds experienced growing inflows as institutional investors sought exposure to silver without taking physical delivery. Pension funds, hedge funds, family offices, and wealth managers gradually increased allocations. Individually, these purchases appeared manageable, but collectively they removed significant quantities of available investment silver from the market. Physical demand became especially noteworthy. Dealers reported increased purchases of silver coins and bars by retail investors. Many buyers preferred holding physical metal rather than paper representations because they wanted direct ownership without intermediary risk. Government mints in multiple countries struggled to keep certain popular silver products consistently available as demand periodically exceeded production capacity. Premiums above the spot price began widening. Normally, physical silver products trade at modest premiums reflecting manufacturing, distribution, and retail costs. During periods of elevated demand, those premiums expanded significantly because inventories tightened while buyers competed for limited available products. Investor psychology also played a crucial role. Markets often remain quiet until important price levels are crossed. Once silver approached previous resistance levels, many traders who had been waiting on the sidelines entered positions. Technical analysts identified breakout patterns, suggesting further upside momentum. Algorithmic trading systems added additional buying pressure. Modern financial markets increasingly rely on computerized trading programs that automatically execute transactions based on predefined conditions. When silver exceeded important technical levels, these algorithms generated additional purchase orders almost instantly. Short sellers found themselves under increasing pressure. Traders betting against silver had borrowed metal expecting prices to decline. Instead, prices continued climbing. As losses mounted, many were forced to buy silver to close their positions, adding further upward momentum. This phenomenon, commonly known as a short squeeze, can accelerate price increases far beyond what normal buying activity might produce. Media coverage intensified as prices continued rising. Financial television programs invited precious metals analysts to discuss the rally. Newspapers published stories highlighting silver's remarkable performance. Social media influencers produced daily videos explaining why silver might continue climbing. The public's attention often arrives late in major market cycles. Once mainstream headlines dominate financial news, new investors frequently enter markets driven more by fear of missing out than by careful research. Their enthusiasm contributes additional buying pressure, sometimes creating rapid advances over relatively short periods. Currency fluctuations provided another important catalyst. Because silver is typically priced internationally in US dollars, changes in dollar strength influence precious metal prices. Periods of dollar weakness often coincide with stronger silver performance because investors holding other currencies find silver relatively less expensive. International demand expanded as investors across Europe, Asia, and Latin America confronted similar economic concerns. Inflation, government debt, geopolitical uncertainty, and slowing economic growth were not isolated problems affecting only one country. These themes appeared across much of the global economy, broadening silver's appeal beyond any single market. Manufacturers also recognized the possibility of future supply constraints. Companies dependent upon silver for production sometimes increased inventory purchases to reduce future supply risks. Rather than waiting until material became scarce, they secured additional inventories while supplies remained available. Commodity investors began comparing silver to previous historical bull markets. Earlier periods of significant monetary uncertainty had often produced substantial precious metal rallies. While history never repeats exactly, experienced investors recognized familiar patterns beginning to emerge. Mining company valuations also started attracting attention. Investors seeking leveraged exposure to rising silver prices increasingly purchased shares of companies producing the metal. Historically, mining stocks can outperform physical silver during strong bull markets because rising metal prices may significantly increase profitability. Speculative capital entered futures markets, amplifying price volatility. Futures contracts allow participants to control large quantities of silver with relatively modest capital commitments. While these instruments provide valuable hedging opportunities, they can also contribute to rapid price swings as leverage magnifies market movements. Large institutional investors increasingly discussed portfolio diversification. Traditional 60-40 stock and bond allocations faced challenges amid inflationary conditions and elevated market valuations. Alternative assets, including precious metals, received renewed attention as potential risk management tools. Economic data continued reinforcing concerns about long-term financial stability. Government deficits remained historically large. National debt continued expanding. Corporate borrowing reached elevated levels. Consumer debt also increased in many regions. Collectively, these developments encouraged investors to question whether existing monetary policies could remain sustainable indefinitely. Silver's relatively small market size amplified every shift in investor demand. Compared to stocks, bonds, or even gold, the total investment silver market remains comparatively limited. Consequently, even moderate increases in institutional buying can produce disproportionately large price movements. Momentum investors joined the rally after observing sustained upward trends. Unlike value investors who focus primarily on fundamentals, momentum traders often buy assets demonstrating strong price performance. Their participation added another layer of demand as silver continued breaking through successive resistance levels. Global uncertainty surrounding trade policies, geopolitical tensions, and international conflicts further increased interest in safe haven assets. Investors frequently seek tangible stores of value whenever confidence in political or economic stability begins deteriorating. As prices approached $60, psychological resistance became increasingly important. Round numbers often carry emotional significance in financial markets. Traders place orders around these levels because they are easily remembered and widely monitored. Breaking decisively above $60 therefore represented more than a mathematical achievement. It signaled that buying pressure had become powerful enough to overcome expectations that prices would reverse. Once that level finally gave way, market sentiment shifted rapidly. Investors who had doubted silver's ability to reach 60 suddenly faced a new reality. Analysts revised forecasts. Technical charts displayed fresh breakout patterns. Financial commentators debated whether the rally represented the beginning of an entirely new phase for precious metals. Trading volume increased dramatically as market participants rushed to adjust positions. Some investors who had waited for confirmation now entered aggressively. Others who had underestimated silver's strength hurried to rebuild exposure. Institutions rebalanced portfolio. Hedge funds expanded positions. Retail investors accelerated purchases. Physical dealers experienced surging demand, while wholesalers attempted to replenish inventories under increasingly challenging conditions. The move above $60 therefore reflected far more than excitement or speculation alone. It emerged from the interaction of expanding industrial demand, constrained mine supply, inflation concerns, shifting monetary policy expectations, institutional portfolio adjustments, growing physical investment, technical breakouts, algorithmic trading, currency movements, geopolitical uncertainty, and evolving investor psychology. Each individual factor reinforced the others, creating a powerful chain reaction that eventually carried silver through one of the market's most closely watched price levels. After silver crossed the $60 threshold, the market did not behave in the calm, rational way that many mainstream analysts had expected. Instead of stabilizing or pulling back in a controlled correction, the reaction was uneven, emotional, and at times chaotic. What should have been a moment of price discovery turned into a psychological turning point for millions of investors watching in real time. The surprising part was not just that silver moved higher, but how differently the market behaved once that level was breached. The usual patterns of hesitation, profit, taking, and consolidation were replaced by a wave of behavior that revealed deeper structural stress within the market itself. In theory, when an asset reaches a major resistance level like $60, markets tend to slow down. Early buyers usually take profits, new buyers become cautious, and price action often compresses into a range before the next major move. That is what textbooks suggest. But real markets are driven by emotion, leverage, liquidity conditions, and institutional positioning, not textbooks. Once silver crossed that psychological barrier, those forces began interacting in a way that produced an entirely different outcome. One of the first reasons for this unexpected reaction was the imbalance between physical and paper markets. For years, silver trading had been dominated by paper instruments such as futures contracts and exchange-traded products. These instruments create the appearance of abundant supply because they allow large amounts of silver exposure to be traded without physical metal changing hands. However, when price levels reach extremes, confidence in paper claims often begins to weaken. Investors start asking a simple question: how much real silver actually exists compared to what is being promised on paper? As silver pushed above 60, that question became more urgent. Institutional participants, especially those with large exposure through futures contracts, began reassessing counterparty risk. In normal conditions, most traders assume that contracts will be settled without issue. But in stressed conditions, especially during sharp price increases, doubts begin to surface. If enough participants simultaneously demand physical delivery instead of cash settlement, the system becomes strained. That fear alone can change behavior dramatically, even before any actual shortage occurs. At the same time, liquidity in the silver futures market began to thin. Liquidity is what allows large trades to be executed without moving the price significantly. When liquidity is strong, even large orders are absorbed smoothly. But when liquidity weakens, even moderate buying or selling can create exaggerated price movements. As silver moved above 60, market makers and liquidity providers became more cautious. They widened spreads, reduced position sizes, and limited exposure. This reduction in liquidity that each new wave of buying had a larger impact on price than it would have under normal conditions. Another major factor was forced positioning among leveraged traders. The silver market, especially in futures and derivatives, often attracts high levels of leverage. Traders can control large positions with relatively small amounts of capital. This structure works well when prices move gradually, but becomes dangerous when volatility increases. Once silver broke above key technical levels after 60, margin requirements began to rise. Traders who were already highly leveraged suddenly faced margin calls, forcing them to either add capital or close positions. When a large number of leveraged traders are forced to exit at the same time, it creates a feedback loop. Selling pressure drives prices temporarily in one direction, but in this case, the dominant force was not just selling or buying alone, but rapid position adjustments in both directions. Some traders were forced to sell, while others were forced to buy back shorts, creating instability rather than a clear trend. This type of environment often produces sharp spikes and sudden reversals within short time frames, which is exactly what began to appear in silver's price action. Institutional behavior also shifted noticeably after the breakout. Many large funds had predefined risk models that treated $60 as an extreme threshold for silver. Once that level was crossed, internal risk systems triggered rebalancing actions. Some funds reduced exposure simply because volatility metrics exceeded acceptable limits. Others increased hedging activity to protect gains from earlier positions. This did not create a unified direction in the market. Instead, it created conflicting flows of capital, with some institutions buying while others were reducing exposure simultaneously. Another important reaction came from short sellers who had underestimated the strength of the move. Throughout silver's climb, many traders had maintained short positions based on historical patterns, suggesting that price rallies eventually exhaust themselves. However, when silver broke above 60 with momentum instead of rejection, these short positions became increasingly vulnerable. As losses mounted, short sellers were forced to cover positions by buying silver in the open market. This process, known as short covering, added additional upward pressure but also created instability because it was reactive rather than strategic buying. The psychological impact of the $60 breakout cannot be underestimated. Market participants often anchor their expectations to well-known price levels. For silver, $60 had long been considered a distant ceiling, a level that many believed would take years or even decades to reach again. When that expectation was broken, it forced a rapid reassessment of assumptions. Traders who had previously been cautious suddenly feared being left behind. Investors who had been waiting for confirmation began entering the market aggressively, not because of new fundamental information, but because the price action itself changed their perception of opportunity. This shift in psychology created what is often referred to as a momentum-driven phase. In such phases, price becomes the primary signal, often overpowering traditional valuation metrics. The logic becomes simple: if price is rising strongly, more participants want to participate. This behavior can continue until some external force or liquidity constraint interrupts the cycle. After silver moved above 60, this momentum effect became increasingly visible across retail trading platforms, social media discussions, and trading communities. Retail investor participation surged significantly during this phase. Unlike institutional participants who operate under strict risk frameworks, retail traders are more influenced by visibility and narrative. As silver became a trending topic, new participants entered the market with varying levels of understanding. Some were long-term investors, but many were short-term speculators reacting to rapid price movements. This influx of retail activity added further volatility because retail trading tends to cluster around emotional decision points rather than structured strategies. Meanwhile,